In 1862, during the height of the American Civil War, the United States government imposed its first ever federal income tax. This groundbreaking financial measure was introduced as part of the Revenue Act of 1862, signed into law by President Abraham Lincoln on July 1st of that year. The primary motivation behind this new tax was to help fund the Union's war efforts against the Confederacy. The Civil War had placed an enormous financial strain on the federal government, and traditional revenue sources were insufficient to meet the mounting costs of the conflict. The 1862 income tax was progressive in nature, with rates varying based on income levels. It imposed a 3% tax on annual incomes between $600 and $10,000 and a 5% tax on incomes above $10,000. The tax was not applied to incomes below $600, which exempted most wage earners at the time. This initial income tax was intended to be temporary, set to expire in 1866. However, it laid the groundwork for future income taxation in the United States. The implementation of this tax also led to the creation of the Office of the Commissioner of Internal Revenue, the precursor to today's Internal Revenue Service, IRS. Although the tax was repealed in 1872, it set a precedent for federal taxation of personal income. This paved the way for the eventual establishment of a permanent income tax system with the ratification of the 16th Amendment in 1913.